welcoming you to your office.
Yeah, glad to be here.
All right. So we have a few questions that come up a lot with clients in regards to taxes and their real estate. And this is mostly in regards to investors that are selling their real estate. And the number one thing is, how are my gains going to be taxed?
Sure. So in all scenarios, the gain portion is going to be your appreciation at a bare minimum. So if you buy a property for, let's say, $10 and you sell it for $15, you have $5 of appreciation. So you're always going to pay tax on that $5, no matter what, in an investment scenario. If your property is a rental property, then you will depreciate down that $10 purchase price. You will use that depreciation to offset the rent that you receive throughout the years, which is good for your current taxation. But then that reduces your basis in that property. Therefore, when you go to sell the property, you will pay tax on both the appreciation, the $5 we spoke about, and the recouping of the depreciation you've taken through the years.
Okay, and then just tax 101, can you just define basis for us?
Absolutely. So basis is normally the cost of the property plus any major improvements to it. So I say major improvements. If you repair a lock on a door, that's a repair. We just expense that off. You redo a bathroom and you spend $5,000, that we can't deduct immediately. That becomes part of the basis to that property.
Okay.
So in our example, we had $5 or $10 into the cost of the property, plus we spend $5 to improve it. Our basis is now $15.
So as an investor, when I sell it, am I going to pay income tax long-term capital gains? Sorry, that's not income tax, but long-term capital gains or short-term capital gains?
As long as you've owned the property for more than a year, and almost always in an investment scenario, almost always you would, especially in a rental scenario. So as long as you own it more than a year, then you get long-term gain treatment. If you sell it less than a year, then it's short-term gain.
So if I'm a house flipper, that's going to be basically income.
It'll be ordinary income. Yep. So if you own it less than a year, ordinary income, taxed like anything else that you have. Interest, dividends, etc. It would be just like that.
No self-employment tax.
Normally not. If you're in the business of flipping properties, then I may give you a different answer. But if you do this once a year or on the side, then it's not your normal course of business. Then normally you will not have self-employment tax.
Is this different if your investment property is owned in an LLC or just your personal names?
Doesn't change the answer. So you would pay the same style of tax either way. One thing that you mentioned about long-term or short-term, this gets a little bit in the weeds, but not too bad. On a rental property, long-term gains can be taxed at a couple different rates, but you will pay one rate on the appreciation. Again, the raise in value from the time you bought it to the time you sold it. You will potentially pay a different tax rate, higher, on the depreciation recapture.
Whoa!
So what I heard is that when you sell your investment property, you should call someone that works at Simplified Tax and Accounting and ask them what to do.
It can be convoluted, especially upon sale. It definitely gets confusing because there are different tax rates based on the different pieces of the puzzle.
Okay.
Got it.
We talked about the cost basis, so thank you for that. Oh, here's one that comes up with some frequency for investor clients. Can I do a 1031 tax deferred exchange, and how does that work?
Yeah, so the key word that you said was deferred there. So a lot of times clients think if I do a 1031, the gain magically goes away. Unfortunately, it does not. It just postpones that gain. So if you're an investor and you want to continue to buy and move up in value, a 1031 is a great way to do that because you're not having to set aside money from your sale to pay the tax. Instead, all those dollars can go into the new property.
So if I want to sell my single family to be able to buy a duplex, I could use the
Perfect
proceeds,
example.
use that
absolutely.
for the down payment.
So the couple keys to that is, one, you need to go up in value to really get the bang for the buck of the 1031. All the money needs to go into the new property. If you keep any of it, that's taxed. That usually convolutes the situation and you don't get the value from that 1031.
Could you use part of it for improvements, capital improvements, like you were talking about before?
Typically, as long as it's rolled into that purchase and then usually held in escrow and then used to do improvements, approved, type of like that, where you're not, as long as you don't touch the money.
Yeah,
That's
so, and like what I have learned from doing 1031s is the title company will not give you any dollars.
Right.
Like it has to go all to the 1031 company and then come all back. And you can't decide that at the last second. You
No,
have
this
to
is
have
long-term
it is
planning.
like
Yeah.
in the contract when you write it, because there's certain verbiage that needs to be in the contract that the buyer's also going to agree to.
And the other couple keys there is the timelines are specific. You have to identify. You have a certain amount of time to identify
Right.
replacement properties.
Mhm.
You have to then close on those properties that
Yes.
you pick, and then you have so much time to do it after that. So
So this is something to work in conjunction with not just your tax professional, but your real estate professional, because they're tight. Their time frames are
those
tight.
are
6
tight.
months?
And yes, that's for the full close. You get a shorter period
90
for,
days to identify.
for the
them.
identify. That's exactly right.
Okay.
And I one more thing to that too. Just again, we mentioned deferment. So at some point, you sell a $50,000. You have $50,000 in gain on a rental, and you buy a $100,000 new property. Know that in the IRS's eyes, that new property really only costs you $50,000 because that gain that you deferred reduces down the cost basis of your new property.
Interesting.
So it's a
Yeah.
true kick the can down the road unless you end up holding that property till death. Then different answer. But know that it's not. I'm not going to pay tax. It's just I'm going to pay tax later. And in theory, hopefully you're in a lower tax bracket when you do that, and therefore it's not as painful when you do finally eventually sell that last piece of the puzzle.
That's the strategy. Okay.
All right. So no matter what, in summary, call your tax professional. We're going to link contact information to Nikali down below. So check it out.